Boop boop ba boom ba dum bum. Boop boop ba boom ba dum ba da dum da dum da dum ba dum bum. Beep ba boop ba boop ba boop da ba dum bum. Beep ba boop ba boop beep boop ba ba dum bum. Hello, ladies and gentlemen. This is David Lentz with ReasonandBalance.com, and this is we're here. I thought I would show you a few graphs and charts indicating some interesting. I have decided to approach this from a slightly different angle, and so I'm going to reverse the order of this video. So we will come back to the whiteboard discussion in a minute. But first of all, I'd like to show you some other things because I think that they will help you make better sense of what I'm going to talk about. Figures. Okay, welcome to the slide portion of our discussion of international trade, exports and imports, the trade deficit, and what have you. I'll just supplement this. Of course, we mentioned to begin with that, well, why even pay attention to the video? First of all, we're talking about the health of the economy. Talks about people's job security. That probably includes yours and mine, your wages. You compete against foreign workers. Oh man, let's see here. Foreign workers and foreign companies. There we go. Cheap labor and technology, of course, affect your jobs as well. The price you pay for goods at the store. You know, a lot of the excellent prices that you find on Walmart or on Amazon or whatever, because the products are produced overseas and they utilize the cheap or I should say inexpensive means now of transporting goods over the ocean because of containerization. Also, of course, Amazon has been very, very successful as well. The price that you pay for goods at the store, of course, are affected by foreign trade. We just discussed that. And of course, foreign trade and President Trump's campaigning on backing out of certain foreign trade deals to get a better deal for the American worker. So obviously foreign trade is very important in terms of elections, both for the presidency and for the Senate, House of Representatives, and whatnot. Other factors that are important to you are foreign trade does, on a certain level, affect interest rates, car loans, mortgage loans, and we're going to talk about in a little bit in this video, as we did in another video, about interest rate parity and things of that nature. So foreign trade basically affects virtually everything in terms of the economy anymore, and one of the reasons for that is that the economy isn't just of the United States anymore. We live in a globalized economic world where the fate and fortune of virtually everybody is at least influenced by, if not tied to, the fate and fortune of other countries. So that's what we're talking about, and that's why it's relevant to you. How trade fits into the health of the U.S. economy. Well, we're going to come back to this point. This is where this video ties into previous videos that we've done on both fiscal policy and monetary policy at ReasonandBalance.com. And I just wanted to show you here that this AD equals C plus I plus G plus NX which is consumer spending, investment spending, government spending. That all equates to aggregate demand. And in addition, you throw in NX, which is net exports. But in our case, because the United States has had a trade deficit basically since the mid-1970s, that's actually a negative number. So that's how we come up with basically this formula down here. It's consumer spending plus investment spending plus government spending, and since it's a trade deficit, it's actually a minus NX. So in any event, we'll come back to that. But anyway, we had another video on David Ricardo's theory of competitive advantage and how that demonstrated that for all countries that engage in foreign trade, basically free trade under Ricardo's theory basically allows everybody to benefit as long as the countries involved focus on producing and then exporting what they are most economically efficient at producing, and allowing others to produce goods that they are less efficient at producing. It's called the theory of competitive advantage, and it was basically a theory that was built upon something that Adam Smith, who's known as the father of capitalism, espoused in his his very famous book, The Wealth of Nations. Well, David Ricardo, a British economist in the early 1800s, came along and built on Adam Smith's original theory of absolute advantage. David Ricardo came up with notions of comparative advantage, and showed how free trade increases the wealth of the countries involved. Importantly, there are some assumptions that Ricardo made when he came up with that example that we demonstrated in that video. He made some assumptions that are indeed sort of unrealistic, but most economists, when they've done studies to see whether or not free trade actually works under Ricardo's theory, even when they relax some of those unrealistic assumptions, they found that his theory still holds water. So let me see here, we'll open up that a little bit. So in any event, and I showed this thing here. One study has suggested that the elimination of trade barriers since World War II has increased the income of the average U.S. household by somewhere between $7,000 and $13,000 per year. Now that is unbelievably healthy. That's quite a benefit. You can check out Mr. Scott Bradford and Paul Greiko's and Gary Huffbauer's article on that, and there it is. You see it right there. But there are several studies, and most of the studies that economists have done basically come out pro-free trade in terms of supporting Ricardo's theory. Here's a sort of an outline of some of the factors that affect the balance of trade. Currency exchange rates is one, and once again we do have videos on this at reasonandbalance.com. First of all, you need to know that as the U.S. dollar goes up, normally our ability to export goes down. I'm talking about the value of the U.S. dollar against foreign currencies. As the dollar goes up, our ability to export goes down because the prices of our goods overseas are more expensive to foreigners, and on the converse side, as the value of the dollar goes up, imports become cheaper, relatively speaking, and this is sort of one of the reasons why we run a lot of trade deficits in this country. What determines foreign exchange rate of the U.S. dollar? First of all, supply and demand for the U.S. dollar. That's just basic economics. Well, what's determines supply and demand? depends on comparative interest rate. A lot of things, actually, a lot of things. One is comparative interest. Everything's comparative in this regard. You compare U.S. interest rates versus foreign interest rates. If they're, and we're basically talking about real interest rates after you take into account inflation. So it's very important to know that they're talking about real interest rates here, not just real without inflation. So you subtract out inflation. So basically, that's where the next point comes in. You do comparative rates of inflation because you have to take inflation into account. So interest rates, inflation rates, the comparative fiscal and monetary policies, and the reason for that is those two things set into account the amount of government spending, and they feed in their foreign countries' fiscal policy versus our fiscal policy, and our monetary policy feeds into inflation in overseas and here. And that's how that ends up affecting the dollar. So it's always comparative, us versus, on each of these points, on interest rates, inflation rates, monetary policy, fiscal policy. Let me mention also, importantly, that very significantly, the U.S. dollar is what's known as the world's primary reserve currency. And what that means basically is that in the world economy, anytime countries buy each other's goods, in a lot of instances, maybe more than 50% of the time, they settle up and they other countries buy and sell currencies using the U.S. dollar. Also, it has to do with the types of accounts you have to maintain at the IMF, the International Monetary Fund. But the U.S. dollar is the primary reserve currency in the world, and because it is, and it's used so much for other purposes, to conduct foreign trade and everything, even when the United States isn't involved directly, that means there's always a lot of demand for the United States dollar, which in turn, anything that has a lot of demand pushes its value up relative to other currencies, and this gives the U.S. dollar a strength bias that makes our exports a little less attractive to foreign buyers, and it makes imports to U.S. consumers seem less expensive. So that fact that it's a primary reserve currency is very important. And if you look at some of our other videos, and especially on currency valuations, we discuss purchase price parity and interest rate parity up here, the international Fisher effect, and all that stuff in the currency valuation videos. Also, factors affecting the value of the U.S. dollar is apparently there are some studies that show that if countries whose economies are booming, their people have a tendency to develop a taste for imports. So that sort of drives some of the fluctuations in values of currencies, differences in expected rates of return on investments. That's important. A really important, another one besides being a reserve currency, is the United States is always considered to be a safe place to park money. That creates demand for the dollar. And why is that? Because the United States has always had law and order, the rule of law, economic stability relative to other countries, and so it's it's a stable place, more so than other countries. So that has a tendency to push up the value of the dollar. Also, expected future actions of the government and the central bank. That actually goes to the same thing as fiscal and monetary policy. That also affects. Of course, then there's speculators. Sometimes speculations leads to what's known as self-fulfilling prophecies. And also there's a notion of efficient markets it's basically the same concept that applies to our discussion generally in video on investments. I won't go into it here. But that has a role. Okay. The U.S., like all governments, has direct tools that they use to directly influence foreign trade. Tariffs, subsidies, import quotas, voluntary export restraints, excuse me, local content requirements, administrative policies, which is red tape, anti-dumping laws and other treaties, executive agreements and laws and regulations that directly address trade issues. I'll give you some examples there. Okay. Okay, and sometimes the Fed will make decisions regarding money supply, etc., that are designed directly to influence the value of the dollar. Okay, all right. So let's put this. Okay, we are back, and we are going to continue with the discussion of international trade, exports and imports, balance of trade, trade deficits. Let's see here. Wait a minute, is this right? Okay. So I guess we're on screen recorder. Okay, so we're going to start. Okay. We were talking about direct tools, governmental tools affecting international trade. But now we're going to talk about some indirect ones very, very briefly, because we've hit on them before. Not only earlier in this discussion, but also in some other videos, which you can see at reasonandbalance.com. One is about fiscal policy, and the other is about monetary policy. Now, both of these things affect money supply and/or inflationary expectations, and as we know, as real interest rates increase, that has a tendency to attract the interest of foreign investors, which, like I said, after you subtract out inflation, if the real interest rate on U.S. investments is higher than abroad, it makes the dollar more attractive, which strengthens the dollar, which makes exports less attractive to foreigners, and it makes imports more attractive to U.S. residents. The converse is also true. Let's say, for example, if interest rates stay the same, but inflation goes up in America, that means real interest rates have gone down. That would have a tendency to be unattractive to foreign investors. That would push the U.S. dollar down, which would actually make U.S. exports more attractive to foreigners, and it would make imports less attractive to Americans. So that's just an example. But we discussed that in a little more detail in some other videos, which I've mentioned. Okay, let's talk about the actors affecting trade policy. Naturally, Congress and the President are involved in fiscal policy. That's government taxing and spending. That's messing around with the tax code, the U.S. budget, and how they spend federal revenues, namely your tax dollars. The President alone can periodically, if he can't get Senate approval for some agreements, he can go the executive agreement route on some things. The Federal Reserve Board has a major impact, and it basically sets monetary policy, which sets money supply. And the money supply has an effect on interest rates, which we described as having an effect on currency values, and also that has an effect on inflationary expectations. National Department of Homeland Security, they run the Customs and Border Protection, but there are other departments also that affect international, have some effect on international trade. I guess the Commerce Department, I guess, would be in there somehow. But okay, the international trade landscape is dynamic. Actions, then other governments and other actors react to what the U.S. government does, and vice versa. We can react to what they do. Sometimes the U.S. does so, especially like the Federal Reserve may do so consciously. Maybe they don't. They just act, and then without really thinking about the international trade ramifications. But all of those things that we've just discussed do have an effect on currency values, which has an effect on exports and imports in some way. Naturally, foreign governments, we have the Federal Reserve here. Foreign governments like the European Central Bank, for example, would be an example of a foreign central bank. They set monetary policy, their own monetary policy, much like our Fed does, and that has effect on currency rates and the rates of exchange. They have their own legislatures and executives and their own bureaucracies. Red tape naturally affects, getting imports in or exports out and all that. So they also affect the balance of trade. International actors, well, of course, the one that has arisen since 1995 is the World Trade Organization. That's the big one. And so that sort of look at the World Trade Organization as sort of being the kind of the UN of commerce, so to speak. We'll talk about that a little bit later. So I guess the big takeaway from all of this is and what you should keep in mind is that regardless of what any politician tells you, in essence, nobody has total control over trade policy. I mean, you can go in there and negotiate agreements all you want, but it's a very dynamic process, and there are a lot of other institutions that may have a say in what the heck is going to happen, and so it's you need to keep that in mind. In any event, all right, so then this is an important section because we're going to talk about some of the tools, I guess, of international trade, and we've already mentioned them. I think we've listed them already. We're going to sort of, for example, tariffs and direct subsidies and things of that nature. But they all always raise the same, a lot of this, not always, but generally speaking, they raise a lot of the same issues and concerns and arguments, both pro and con. Basically, the people who oppose anything that removes tariffs and makes trade freer generally say they want to protect American jobs. They want to protect American worker. And they want to raise, and basically also they say if they impose tariffs to protect American jobs and wages, that a tariff, an import tariff, for example, if they're going to put tariffs to import, which is an additional charge when goods cross the border, for example, if it was cars or radios or computer chips or whatever, the federal government charged a tariff on those, an import tariff, that raises money for the federal government, which is great, but on the other hand, like if the U.S. government would, for example, provide subsidies, for example, like agricultural subsidies, like it does for like agricultural goods, that actually is an expense for the government, and it's a cash outflow. So even though tariffs are normally U.S. imposed tariffs on on imports into the United States and raise revenues, subsidies to pay like that we pay like on some agricultural products actually cost the federal government money. So for those arguments, those typical arguments, they have to be balanced against what the proponents of free trade normally say. And the proponents, of course, have a different version of things, and they have a different focus. Like what we've already talked about, Ricardo and Adam Smith, that free trade, doing away with tariffs and not having subsidies or anything like that, increase free trade, and that increases the wealth of America or any nation that engages in free trade. It also has a tendency to lower domestic prices on imported goods, which frees up cash for like American consumers to buy other products, which also provides stimulation to the economy. And that, like I said, creates or supports other jobs because of the freed up cash that Americans would have to spend on other things. For example, like if an American sweater cost $30 and all of a sudden a sweater from, we'll say, from Vietnam costs $20, well, the American consumer is saving $10 that they can spend somewhere else, which may allow some other American in some other industry to be employed. And also, another thing is if American products have to compete against imports, even if they're cheaper, it forces American companies to be more efficient and helps make them more competitive when they try to export their own products. So it also develops efficiency. To the extent the companies have to, buy new technology to make their production facilities more efficient. It's sort of like a tough love type of argument. It forces them to be technologically proficient, to have a skilled workforce and be efficient. And efficient, competitive companies give their workers the ultimate job securities. Okay, opponents of free trade, other nations. Going back to what the opponents of free trade argue, they basically say that other nations have unfair competitive advantage over the United States because they don't have child labor laws like we do here. That allows them to pay lower wages. They don't have like OSHA, Occupational Safety and Health Administration, that they have sweatshop conditions and unsafe working conditions that American companies can't have under OSHA rules, for example, that allows them to be able to cut costs. And they also are big polluters. And I guess they're talking about the Chinese there in particular. They say that all those things allow foreign countries to have an unfair competitive advantage. And then I raised the question there, can it be solved by other means, like something like the non-trade related, like the Paris Climate Accord, which there's been a big question about whether we're going to, be involved with that or not, but that's another subject. But there's what I call a fair trade solution. You can address those issues, the child labor, the sweatshop conditions, pollution, as part of any trade agreement. When you enter into a trade agreement, say you have no tariffs, for example, or no subsidies or whatnot, you say, well, you also cannot pollute the atmosphere. You have to only hire people that are more than 17 years old or whatever. And also, the question is to the extent to which GATT and NAFTA, for example, and even the World Trade Organization have rules concerning these these types of issues within those treaty frameworks. Okay, and what I got here then at this point is assessing free trade. I have here a brief history of all of this stuff. One thing that I want to note here in going forward with this was, back in the early days of this country, tariffs and the money that the federal government raised, taxing imports and exports, was a primary revenue generator. Remember, in this country, we didn't have an income tax until, I don't know, the early part of the 20th century. I think it was 1916, I'm not sure. But so tariffs were a big deal in the old days. They were as high as 44% in 1913, right before World War I. And but there was hardly any importing or exporting. I mean, a tariff rate of 44%, you're basically almost adding 50% to the cost of a product. Let me just say this. A lot of economists and historians alike blame the Smoot-Hawley Act of 1930 right after the beginning of the Depression, and it raised tariffs because Congress wanted to protect American workers. There were a lot of unemployed people, and so they thought that if they raised a lot of tariffs and erected a lot of trade barriers, that it would solve the employment problem in the United States. Well, it had just the opposite effect. When those tariffs went up here, other countries did the same thing to us, and it totally cut off all foreign trade, basically. And the result was it hurt employment in the United States, and it hurt employment abroad, and deepened basically a worldwide depression, which probably facilitated allowing the fascists to come to power. For example, in Germany, the depression in Germany was just awful. It was a lot worse there than it was here. That's a history lesson. But in 1930, and Roosevelt sort of saw through this, and in 1934 he tried to enact and got through. In fact, he did enact. Well, he didn't. Congress had to go along with it too, but he was able to get through what's called the Reciprocal Trade Agreement Act, and allowed for agreements with foreign governments to reduce tariffs. But the thing of it is that helped the situation. But the problem probably was, and there's a gap here in the thing, but of course in here somewhere between 1934 and 1950, we had World War II, and it probably was a little bit too little, too late. We had World War II, and which basically left Europe and Japan and, well, even the Soviet Union back then pretty much all devastated. But after the war, people were sort of desperate to get the economies going. The United States was really the last man standing. Everybody else was just really clobbered. Their industrial base had pretty much been annihilated, and we came up with the Marshall Plan and whatever. But Congress became sort of fairly pro-trade. By then they had reduced the tariff rates down to 14%. Remember, it was at 44%. And if you'll notice in all these things, I have the export levels and the import levels, and they keep going up. As the rates go down, the amount of trade goes up. And now, there's some interesting here. In 1971, we had Bretton Woods in here, where we had the gold standard, and I briefly discussed that before Bretton Woods. I discussed in the video on dealing with David Ricardo and free trade. But in 1971, Nixon removed the dollar from having a conversion, being convertible into gold. And that was major, and it made the U.S. dollar fiat, what's known as fiat money, and it left the value of the dollar float. Prior to then, you could redeem dollars for so much gold, so many ounces of gold. And for a variety of reasons, there was a run on trying to cash cash in on foreign countries, and I think particularly France was wanted to convert all their dollars to gold, and it really depleted our gold reserves. It created a monetary crisis, and Nixon eventually in 1971 took us off the gold standard. And we've been on a floating rate ever since then, not tied to gold. But anyway, in any event, as we've moved forward and as trade has basically gotten freer, the amount of trade has just gone up incredibly. Now, part of that is because the trade barriers have been going down, but also another part is other countries, especially after the Marshall Plan, the United States helped them rebuild their economies so they could actually pay money and actually become more economically healthy, which basically gave us more people to trade with, actually. And so you can see by the numbers here that they keep going up. And and I just note here, they talk. It's what's really one thing that's really interesting about this is that people talk about we've got to be able to export more, and which is true in terms of evening out the trade imbalance that we have, so we don't have trade deficits. But the fact of the matter is that our export numbers have been going up, up, up. So we should be able to, exports. It's not that they're just terrible. It's just that if you look in comparison to the import numbers on here, they're just not going up as fast as the import numbers. And I've described a bunch of reasons for that, like the reserve currency aspect and all that. And there's other factors also. We talked about, well, here it is. Here's the U.S. dollar as a reserve currency. What is a reserve currency? It's a currency held by other governments and central banks, and it's used. The U.S. dollar is the world's most important major reserve currencies. There are other reserve currencies, but the U.S. dollar is used by other banks and other governments to help finance their foreign trade, a lot of their foreign trade. That means that there's a lot of demand for dollars out there. If there's a lot of demand for dollars, that pushes the value of the dollar up, which makes our exports, relatively speaking, a little less attractive to foreigners, but it makes imports here to Americans more attractive, so that hurts our trade balance. And the fact that it's a reserve currency always means there's a slight bias that we have to overcome if we want to correct a trade imbalance, because the slight bias tendency of the dollar, because it's a reserve currency, is to make our exports a little less attractive and imports a little more attractive. And there's other reasons too. The U.S. dollar is also attractive because the United States is governed by the rule of law. It's relative to other places a peaceful place, governed by the rule of law, and people trust American institutions to abide by the rule of law. So it's deemed to be a safe place to invest. That also helps to push up the value of the dollar. So ironically, when people worry about the weakening dollar, that we might be best served if the dollar did weaken some, because that would be good, because it would help the U.S. export goods. But in part, because it's a reserve currency, the dollar has a bias towards being strong, which has a tendency to hurt our ability to export goods, which in turn is always going to make us, well, I don't know if always, but it makes it a little bit more of an uphill battle for us to cure a trade imbalance than it is for a lot of other companies, or a lot of other countries. Often vital considerations regarding trade policy. Sometimes questions in terms of trade agreements, naturally always a big one is are we compromising national sovereignty? We'll delve a little bit more into this when we talk about the World Trade Organization, but that's always sort of a hot topic. There are costs and benefits of trade agreements, and we will discuss those a little later on. Okay, what's the alternative? Sometimes it's war versus peace, trade, barriers, free trade. We've sort of touched upon those. A more recent idea is the concept that if poor countries develop, that free trade helps poor countries develop, and this one inhibitor to the third world countries of developing their own agricultural system, so they can develop and produce their own goods. A lot of people say that if the United States, for example, would stop subsidizing domestic American farmers, which they say are any more large corporations anyway, and not the family farmers really not even the one being advantaged by this that large corporate interests are, that if we did away with our agricultural subsidies, it would allow other countries, poor countries in other parts of the world, develop their own agriculture that could provide relatively cheap agricultural products as well. That's a really hot topic in the latest, I think it was in Doha, in the continuing rounds of the GATT discussions. But that's a big issue. Agricultural subsidies paid not only by Americans to American farmers, but also in Europe they do the same things to theirs, so that's been a big point of contention. The World Trade estimate is if we removed agricultural subsidies and tariffs in the U.S. and elsewhere, the World Trade Organization estimates that worldwide wealth would increase in poor nations by 30 billion and 128 billion for the world as a whole. Now, if that's true, notice that not only would it help poor nations, but it apparently would help other more developed nations by even more. So that's a very interesting analysis. I just sort of cite that for your consideration. I saw that somewhere offhand as I talk about this right now. I can't remember where, but it must have been on the World Trade Organization website or somewhere. I don't know. But anyway. All right, other important considerations of trade policy. Maybe if more free trade, there's less likelihood of immigration problems. Once again, this goes the whole idea of David Ricardo. The free trade raises the wealth level of all nations that participate in it, and that includes of the poor nations. If poor nations were able to develop better, their people would less likely to become destitute and want to leave and immigrate to the United States or to Europe or elsewhere. So it actually, free trade may in fact be one partial solution to the worldwide immigration problem right now, which is causing so much consternation and conflict. Also, if poor nations were able to develop, it would create new markets for American goods. It would also lessen the need for costly foreign aid, ability to cut back. Would that allow us to cut back on defense spending, which of course would end up lowering our taxes here in the United States? So that's one possible argument. And naturally avoid trade wars or worse. Other important considerations, are we talking about trading things that would potentially involve a vital trade secret that necessary to the defense of the country? A lot of times trade policy is used to support foreign policy objectives, namely like sanctions and embargoes against Iran, North Korea, and Russia over Crimea, development of nuclear weapons, what have you. Another policy considerations is Paul Krugman and some others have suggested a new trade theory. In terms of getting certain key businesses only will support a certain number of producers, so the theory goes, like aircraft, jet airliners, for example. There's Airbus and Boeing and very little else in the world. And Krugman and others have talked about maybe it's necessary, maybe it's a good idea to actually subsidize the aircraft manufacturers to allow them to compete in a very important and potentially strategic area of aircraft production. So that sometimes creeps into the discussion. Environmental considerations, we more or less have discussed that. Protecting U.S. consumers from inferior foreign products is also another. Drugs, tainted food have been sort of issues in this area. Intellectual property issues. This has been a really hot button in foreign trade circles. Protecting patent rights, copyrights, trademarks, and things like that, because there's been a problem with people in foreign countries pirating certain products. That destroys the profit motivation to be innovative here domestically and abroad for that matter, and because it wipes out some of the potential products. So protecting intellectual property interests, there's an agreement called the TRIPS agreement that's let's see, which has helped eradicate some of that problem to a certain extent. That stands for, I think, I'm going to be tested here, I think that's trade-related intellectual property something. Secrets? I don't know. Trade-related intellectual property, I've forgotten what the S stands for. Okay, and national defense, that's sort of up there, the first one, that's already in there. Are we talking about, all right, so we can take this off, really, because it's already in there. That's up here, as you can see. Okay, other important considerations regarding trade policy continue. I'm going to come down here. We've got strategic businesses, key industry. We talked about that. Aircraft, software, maybe semiconductors. Let's see. Those may have been examples in the past. Okay, I think we've already talked about these. We've talked about these, so we can actually more or less get rid of that page. We're not getting rid of the concept, just the redundant page. Anyway, so now we can address certain types of governmental tools that affect foreign trade directly. Tariffs are basically an additional charge, like a tax on imported goods, but they can apply to exports as well. If on imports, they provide the U.S. home government with revenues, which is nice for the United States. It helps protect producers here at home and U.S. manufacturers from, actually this should be from, competing products, helps protect them from foreign competing products. One of the big ones, of course, is that they protect existing jobs. We've mentioned this already, right? And how about we can also add to this probably in wages too, wage levels also. But some of the disadvantages on the other end. Consumers pay more for the imported products if they are subject to import tariffs, and U.S. competing products probably as well, because the U.S. producers if the imports are subject to a tariff, U.S. companies don't have to lower their prices. They can maintain them at artificially. Well, in order to, there's no reason for them to lower their price unless they're being aggressive and trying to increase market share. But anyway, it means that Americans are going to pay more if imports on those products are subject to an import tariff. If there's no tariff, for example, this is an important, American consumers would have extra cash to spend on other and thus that creates other jobs. So if you allow imports to come in without an import tariff, that means the goods are cheaper, the imports are cheaper, and it frees up cash on the part of consumers to buy other products. The question, of course, is what other jobs are created and how much would those jobs pay? This has been a source of controversy, and some people, because of the loss of America, of course, the folks on the negative side of that want to impose tariffs say that the jobs that are lost by allowing cheap imports here aren't the cash that's freed up are only for cheap minimum wage jobs, and so you're losing high-paying jobs from cheap minimum wage jobs. And so it ends up being a net loss for the United States. The studies, there have been studies that have addressed this particular issue. I think an economist by the name of I can't remember if it's Paul. I always get him and his dad confused. His dad was a very famous economist, but anyway, his name is Samuelson. He did a study on this. And I think that, I'll leave it to you for your own further study on that. I think, although I think that there is some room for some argument on both sides, I think where the current thinking is on this, once again, is that that the loss of high-paying jobs in America is, in fact, slightly more than offset by the cash that's free, the advantages of having the cash freed up and the creation of the other jobs. So in other words, I think it slightly comes down on the side of free trade once again, as opposed to imposing the tariffs. But I could be wrong on that, so I'll leave that to your further study. All right, okay, let's see here. Subsidy, okay, this is subsidies to domestic producers. This is like I was talking about before, the subsidies to agricultural products. Naturally, like I said, with respect to if you were going to subsidize, for example, help Boeing build aircraft so they could compete on the world stage with Airbus in terms of selling big airliners abroad, that's sort of what I'm talking about. Sort of that and agricultural subsidies to farmers, and some say it's really not going to family farmers as much as it's going to corporate farming interests. Those are the situations where I'm talking about here. Now, naturally, that's a cash outflow from the government to these American producers. So unlike import tariffs, which actually raise money, this is actually spending money. The argument on the other side is that by subsidizing, whether it's the family farmer or a corporate farmer or Boeing or whoever, that promotes inefficiency on their part. It doesn't make those companies lean and mean and low-cost producers, which is necessary in the end to compete in the worldwide economy, is to be lean, mean, and efficient and have skilled workers. And if you're always subsidizing them, they don't get that way. They sort of for lack of a better expression, are more likely to be a little bit fat and bloated. So that's the argument on that side. Okay, and that takes us to quotas. All right, let's see. Quotas are usually a form of regulation of imports, and they are designed to restrict the quantity of the amount or the value of imports, or certain products are required to be manufactured consisting of a certain percentage of the parts in that item have to be domestically made, and only the other percentage is allowed to be foreign. Okay. And then there's these things called voluntary export restraints, and this is what the Japanese sort of did with respect to automobiles when they started. Because they were afraid that the U.S. government was going to impose import quotas. So what the Japanese did a couple decades ago is that they voluntarily restricted VER, their own exports, into the United States, so that the U.S. wouldn't retaliate by imposing some kind of trade barrier. But anytime there's a quota, naturally, that has a tendency to keep the price of imported goods higher than they otherwise would be without domestic, higher than they otherwise would be, which of course hurts consumers. And if there's quotas, it usually allows producers to make extra profits, like I said, but it hurts consumers because they're paying higher prices. Quotas have a tendency to save domestic jobs, but consumers generally, like I say, are paying higher prices. Can you think of other advantages and disadvantages? Okay, all right, so that's going to conclude for the time being this segment. All right, so now we're going to go another direct way that this is related to quotas. So I'm not going to talk so much about this, and it basically says that a certain portion of any particular product has to be this drives me nuts. Alright, so we're going to here, domestic government, the United States, for example, enacts a law that says someone must buy products with a certain percentage of certain value of domestic content. It gives you a couple examples. There's this thing called the Buy America Act, and under that act, the U.S. government agencies have to buy American products unless there is a significant price advantage to buying the foreign product. Advantages and disadvantages: makes taxes higher. I guess, yeah, but they must be talking about it because the government has to buy American products. It protects domestic producers. Can make the price of the imported portion higher, which hurts consumers. And can you think of others? Okay. And then there's red tape. And regulations. They're talking about an example would be like Chinese, where they said that the Japanese inspectors, when they deal with imports, are so strict and open every box and things like this that they make it so that even though the country has no tariffs, or subsidies or whatever that they make importing for the exporting company so much of a headache because of the bureaucratic red tape that it has the effect of increasing cost to the producer that's trying to export his product into another country. So that's another way that government can basically affect trade. And then, of course, you might have sanctions, such as what we've done with North Korea and Iran, and I think more recently Russia. Of course, the other thing you can always do is file a complaint with the World Trade Organization in their dispute resolution process, and we will talk a little bit more about that later on. Okay, moving on to a slightly different. Okay, we've already covered this, I believe, so we'll take that out. Okay, so then we come to the very important topic of what do trade deficits mean. The United States has imported more than it's exported since, oh my God, all right, this looks like it's all messed up. But this was either 1975 or 1976, I'm not sure, one or the other. The mid-70s. Like I said, this, in large measure, we talked about currency fluctuations. That has a lot to do with the rise of more and more developing countries that have been able to generate products cheaply. Has been another reason. We talked about the fact that the U.S. dollar is a reserve currency. So we've already talked about that. Okay, so the argument, of course, is that in the long run, the United States, as we pointed out several slides ago, has seen its imports skyrocket, and even though exports have increased, let's see if I can find that slide again. So bear with me here for a second. Here we go. See, they started out down here. Yeah, all right, let's go to 1960, for example, when the United States was still pretty much king of the hill. Europe was still rebuilding itself. Japan and Europe had done a good job and were basically really starting to come up to speed, in the very late 50s and early 60s. And so somewhere around 65 or 66 or something, I'm just speaking from personal experience here because I grew up in Pittsburgh, and we lost a lot of full-time steel jobs back in those days. So I remember what the imported Japanese steel was doing, and then later I watched, foreign automakers. Back in those days, it was the Japanese start to take over and sell a lot of cars here, and that cost a lot of jobs as well. Well, that all started to happen in the early 60s, and by the 70s it was clearly happening. And you were seeing a lot of American blue-collar factory, good, high-paying, in a lot of cases unionized factory jobs losing out to foreign imports because the imports were cheaper. And in a lot of instances, that's another long story, they were also of pretty high quality. And I'll just tell you a little bit of an aside with respect to the steel industry, for example. One of the things that the Marshall Plan and all that did, we helped finance Europe and Japan to rebuild their factories. Well, actually, the Japanese ended up, their plants were actually more advanced than American plants because, like in Pittsburgh, for example, a lot of the steel mills were based on early 20th century technology. I mean, circa 1920, 1930, and the Japanese have more, shinier, new, more productive, technologically proficient plants. So anyway, but as we also pointed out, exports were going up notwithstanding this, but the problem is imports were going up a lot faster. And there you see some of the statistics on that. So anyways, as a domestic country, in this case the United States, keeps importing more and more products, what does that mean for the country? Well, it means that basically the United States is in a position where it becomes what's known as a debtor country because a lot of U.S. dollars have been paid out in order to purchase foreign currency to buy foreign products, namely the imports. And when that happens, a lot of those dollars end up in the hands of foreign corporations, foreigners, individual, non-Americans. And what that in essence means, that the dollars that are held, here we go right here, in the long run, if those trade, and this is reflected now in a trade deficit, if imports are greater than exports, you have what's known as a trade deficit, and everybody screams bloody murder about the trade deficit. But actually, like I said, Americans enjoy cheaper products, which frees up cash. And the United States, and it has made the United States basically a very consumer-driven society, and helps us to enjoy the relatively good standard of living that we have here. But the problem is that we end up with foreigners having a lot of dollars, and then they take that money and they invest it in American assets here, and so we have more and more foreign ownership of products, of properties, I should say, here in the United States. Now, some people might find alarm for that, but that capital that's reinvested here in the United States actually helps the economy to a certain extent. We don't know at what point is the tipping point, but to the extent, let me see, I think I have it here somewhere. Let's see. Dollars that are held and reinvested by the U.S. by foreigners. This is after these foreigners collect dollars because they're selling us products which we import. After they are held and reinvested in the U.S. by foreigners, this increases the investable, loanable funds that U.S. companies and Americans can use to buy plant and equipment to increase manufacturing productive capacity in the United States. That's all great. This would help the productive capacity and competitiveness of U.S. firms, which could translate into more exporting of U.S. products abroad. All that's wonderful, but also large trade deficits also put downward pressure on the U.S. dollar exchange rates, which, interestingly enough, helps to overcome the inherent bias to increase the value of the dollar. We had that discussion about the reserve currency. But this part of it actually puts downward pressure on exchange rates for the U.S. dollar. And that should make U.S. products more attractive in foreign markets and more competitive. But here's the big question. Do persistently large trade deficits mean permanent foreign ownership of too many U.S. assets. Some have concerns about this, but the increase in capital provided by foreigners should help the U.S. economy grow. And high domestic growth typically helps the country buy back foreign debt. But some think, and have expressed this concern, that it is possible that foreigners could soon sour on the U.S. dollar in a big way. And that means if they do that, what do? They will sell. They will, instead of investing, they will sell. But they will sell dollars, making imports in the U.S. extremely expensive. I need to go take remedial grammar. Are there U.S. substitutes? Okay, well, anyway, I asked a question as a part of that. But anyway, they sell dollars, making U.S. imports extremely expensive. Or worse, wow, I really am bad. Let's see. There could be a dollar crisis. And if there is a dollar crisis, given the fact that the dollar is a major reserve currency, it could precipitate a global recession or worse, simply because since the dollar is such a major reserve currency and everybody's holding this, and all of a sudden if the value of the dollar were to collapse, it would have ripple effects on the global economy, which could be quite ugly. So we're talking here, nobody knows for sure about that, but it's like everything else. It's just amazing. There's always good news and bad news. It's just like in economics, there's always costs and benefits to any decision, and that's certainly true when it comes to matters relating to international trade and trade deficits. So talking about American workers getting a fairer shake at things. These statistics, maybe they do, maybe they don't, point to a different situation of what maybe some of the candidates have discussed on the stump. Let's start down here. Maybe it'll give us a little bit of historical context. This is a balance of trade graph, and over here are percentages of gross domestic product, the size of the economy. And a lot of people don't realize this, but back in the late 1800s, in the 1800s and until they adopted the income tax, the federal income tax, a major source of income for the federal government was the money they collected on tariffs on imported goods. So tariffs were a big deal back then, and this graph goes from 1900 all the way up to the present day, and zero means that it's 0% of GDP. And it goes from -6% up to 6%. That's basically giving you the volume of trade, of the trade balance, I should say, exports minus imports. If it's negative, that means that imports are greater than exports. And if it's positive, that means that exports, U.S. exports are greater than imports. Negative means that U.S. imports are greater than U.S. exports. Okay. This graph sort of shows it, and I think I got this off of Wikipedia's discussion of balance of trade. I'm not sure the data for this, but back when they had high tariffs, as you can see, we had a positive. We're up here. This is all positive territory up here. And this is negative. This means imports are greater. This means exports are greater. We're in positive territory, and we had high tariffs 1945, of course, is the end of World War II, and BW is Bretton Woods. That's when there was an agreement on, after the war, there was a desire to free up trade. We'll discuss a little bit more about the history because of the Smoot-Hawley Act that was adopted in the 1930s, the Smoot-Hartley Act. That was because of the Smoot-Hartley Act that was adopted in the 1930s, which imposed high tariffs. It caused a little bit of a trade war, which probably worsened the Depression of the 30s, arguably assisted in giving rise to fascism in Europe, probably was a significant contributing cause to World War II. There were others, of course, but it certainly didn't help because it made for a worldwide economic depression even worse. So anyway, but what I'm saying is there were prior to Bretton Woods, everything was pretty much high tariffs. After Bretton Woods, which had to do with putting the dollar on a convertible gold standard, and all the other currencies of the world were related to the dollar, and the dollar was the only one that was basically convertible to gold, and that was the financial system in this country. The dollar was backed by gold back under Bretton Woods in 1945. Well, long story short, in 1971, Nixon took us off the gold standard because there was a run on the dollar, and I'm not going to get into all the reasons why that happened. But we, up until about 1975 or 76, we'd always run a positive trade balance. After we were taken off gold by Nixon in 71, we started having trade deficits. We're going to have a little bit more of a discussion about whether that's good or bad or what the consequences of all of that. But ever since 1975 or 6, we've always had a trade deficit. And we're going to have a discussion about the World Trade Organization, and that's 1995. And you can see that the trade deficit increased, even though it's going down here. That just means that imports are getting bigger and bigger relative to exports. So anyway, so that's kind of that's a little bit of a historical backdrop. But in terms of the angst caused by the issue of trade in all things, let's just look at a few numbers because they're kind of interesting. As you can see, the World Trade Organization was originated in 1995. So this is the World Trade Organization right here, and we will discuss that in 1995. So 95 is kind of a good year. Well, actually, it was set up in 94 under the Marrakesh Agreement, but it started operations in 95. All right, so in 95, after this is the level of U.S. employment. This is people that have jobs in millions, and you can see after World Trade Organization, well, employment continued to rise in this country. So it's not like trade doesn't, just in terms of total employment numbers, it does not look like it's had any negative effect in that respect. Now, of course, we do have a population growth situation, but if we go back down to here, this is the unemployment level in the United States, and here's the WTO, and you can see after 95, when the World Trade Organization was put into place, and we are a member of the World Trade Organization, which facilitates international trade and seeks to help resolve trade disputes, and it's a big conference that's designed to lower trade barriers, lower tariffs, get people to have the same intellectual property rules and whatnot. You can see that after it was adopted here, the unemployment rate continued to come down. Now, it did go back up a little bit here, and then there was a steep decline, increase right here. But this was Remember during the when Obama was first elected, right before, during the election, we had the financial crisis with Lehman Brothers and whatnot, and that's right in here. As you can see, unemployment spiked back then, but and even though there was ripple effects, because what happens in the United States has a tendency, because its economy is so large, has a tendency to have ripple effects. But this was more of a financial problem as opposed to a trade-related issue. Yes, I don't really want to get into a discussion of a very complicated subject, what the cause of the 2008 recession was, for example. But it was primarily because of problems with toxic mortgages related to the collapse of financial institutions like Bear Stearns and Lehman Brothers and a few others. But there was problems with excessive risk-taking by financial institutions because of lax regulation. But that's a complicated subject. But my point is that was not really a trade-related spike in unemployment. It was due to other causes that precipitated this thing. But I'll leave it to others to discuss how much, if anything, international trade contributed to this. I'll just say that's sort of a key area right here. And so I point those things out. You can see incomes have continued to go up. And since 2008, we have watched the unemployment rate continuously come down for a period of close to 9 years now. This is 2017. So it's right now it's at 4.1%. Sort of what I really want to get into here, though. So as you can see, the World Trade Organization, after its adoption and all that kind of stuff, I mean, what effect it's had on employment in this country looks to me like, if anything, it's been positive. Some people might have other ideas, but okay, real household income. To me, this is a real tall tale sign right here, because it gets to these two things in this. Now, I'm not very precise in here, but I'll tell you, these are the quintiles. Okay, quintile, they take a fifth of the population, and there's 5/5. Plus, they segregate out just the top 5%, so they create a specialized group of the really highest, the very highest of the top. And this is the average income. We see from 1990, the top quintile went from a little under 150,000. This is real inflation. Real means inflation adjusted. Real means inflation adjusted. So real household income since 1990 for the top quintile has gone from a little under $150,000 up to over $213,000. For the top 5% of the earners, it's gone from a little under $250,000 to $375,000. That's a 56% increase. Now I got zeros besides all these guys, because even though it's not exactly zero, for all intents and purposes, if you inflation adjust the dollars, for the bottom 4 quintiles, that should be 80% of the population, of the working, 80% of the households. For the bottom 4 quintiles, there has been, between 1990 and 2015, zero. For all intents and purposes, the numbers are so small that they come out to 0%. That's why these lines are flat right here. These are all the quintiles. For each wage earning group, these lines right here coming across down here. So people haven't gotten a raise, and the more well-to-do folks are doing better. Even in inflation-adjusted dollars, they're doing better. Okay, so that's why we see a sort of not only an income gap, but probably a wealth gap in this country. Okay, and it's shown by these statistics as well. Let's look since 1967. That's a long time ago. That's what, 50 years ago. The top 5% in real dollars. This is not, if it was nominal dollars, these numbers would be even more. But in real dollars, that means inflation adjusted. Okay? Top 5%, their income has increased by 112%. 112%. That means it's more than doubled. Okay? The top quintiles, 91%. That's almost doubled their money. But the point is that as you go down, and these are the minimum wage people, the bottom quintile, these are the people that are making households that are making less than, 40,000 households, combined income, husband, wife, whoever's in the household, making less than like $40,000 a year. They've only gone up 29 and 24%, but everybody above that has gone up more since 1967, and especially the top. And then if you come down to this chart, it's more or less the last time people got a raise, really, a real raise. Well, look, again, these are the minimum wage earners, people that work, checkout counters at fast food or Walmart or wherever. I don't know for sure, but the people that are on minimum wage, their best year was in minimum wage people. Their best year was in 1999. That was their best year income-wise. When they made $14,000 a year, and now it's closer to $13,000 a year. These are dollars. $13,000 a year. So basically, they've lost 9.4%. They're 9.4% worse off than they were in 1999, and the people that are just above that are 2.4% worse off, inflation adjusted wise, than they were in this case in the year 2000. Meanwhile, for the people that are, these are the people in the middle. The people in the very middle, the people at the top, their most recent year, 2016, was their best year. I don't know why this isn't 2016 here, but it's, they've just recently had their best year, so that's why this growth rate is. That's because the best year is so recent that there's no time to improve. So that doesn't mean that their tendency has been to go up anyway, right? Because they're the most recent years. So this is actually good news because it means your most recent year is the best year. So anyway, so it's and I'll just tell you, there's another chart. I didn't put it up here, but it would show the average income, the earnings of salaries and wage earners, the median income going from like 1990 to today, and it goes like this. And so that's if they're making income. So I don't know if this is income, and I didn't put this chart up here, but it shows that wages are actually going up. So then why is it that people feel like they're so poor? Well, I think that part of it is because these are wages if you're working, okay? If you're unemployed, you don't show up in here. And I think that people are may not be working. There's less certainty in their jobs. They probably get laid off more often. I don't know. I don't know what the deal is there. And of course, when you talk about the unemployment rate, a lot of people say that people have given up work and it doesn't actually reflect the actual number of the unemployed and whatnot, but there's a whole lot of discussion about that. But my basic point here is that a lot of the angst has to do more with increasing inequality in incomes.
Yeah, I wanted to sort of elaborate on what I said in that segment. It looks to me like the graphs and charts that I had there on the whiteboard sort of indicate that the move towards lowering trade barriers and the startup of operations of the World Trade Organization have been beneficial for both employment and for GDP in the United States. During those periods where unemployment has gone up, the other causes are probably to blame for rises in unemployment. Now, with respect to the flatness of the four lowest quintiles of the population, in other words, the bottom 80% of the population since 1990, I pointed out in my video on David Ricardo and the theory of comparative advantage that neither he nor Adam Smith really talked about how the additional wealth that's generated by free trade was going to be distributed. Many economists would argue that that's a decision that's really up to the national government and to a lesser extent the state governments in terms of minimum wage laws, tax laws, specifically with regard to tax brackets, preferential treatment for capital gains, and of course unemployment assistance and various other ways that the federal government has an effect on wealth distribution in this country. And the point that I also wanted to make regarding, even if wages are rising, there's also this very important issue. Given the quickly changing nature of technology, that inherently is going to make everybody's job a little bit less secure. They may in fact be replaced and have to retrain more often. People are probably seeing that more and more, and even if the general level of wages would be rising, if you're having gaps in employment, even if there are a couple of weeks a year, that is going to have an effect on the mindset of the general public. Increasing, and in that same vein, and it's probably very much related to the technology issue, is a lot of folks are finding that they're not really getting employment work. They may be getting independent contractor work without benefits and some of the other things that in the past they may have enjoyed. So all these things probably contribute to the general sense of unease that's out there in the population. And I think that those are important things that I think somehow probably color the attitude of many about trade, and they look at trade as more or less a little bit of a scapegoat. Those are just some thoughts on that subject. So in other words, it's not really an issue of free trade, according to some economists. It's more a question of what domestic policy is on how the pie is divided. At the end of this video, I'm going to talk about trade adjustment assistance, which is one program where workers are helped if they've lost their job because of jobs have moved overseas or whatnot. But that's a whole separate video. I just briefly mentioned it. So in any event, nothing, of course, is free from doubt, but that's the way those statistics and those factors stack up to me. And I think probably, I haven't taken a poll, but probably most economists would probably agree with what I just said. So anyway, I just wanted to clarify that part of the video. Thanks.
More recently, both here in the United States with the election of Donald Trump, Make America Great Again and Put America First is what he campaigned on. There's protectionist feelings here. That's part of the Brexit thing has got to do with the same ideas. But several let's go back to several rounds of GATT negotiations. The most famous one has been what's known as the Uruguay round. It took a long time, 86 to 94, and it culminated in a few things. The Uruguay round had some substantial results. These have been big issue areas recently: agricultural products and intellectual property. We'll talk about dispute resolution in a second. But let me see. Let's go back up here. Anyway, one is GATS. It was the. Let me just say this: they've adopted this thing. Originally this stuff was all set up just to apply to manufactured products and goods, but there's this agreement that's part of GATT now, which is GAT, not GATT, but GAT, and that applies GATT principles to services, and financial services. That's a biggie. Insurance. Now, probably even applies to lawyers and accountants and things like that. And the other one is TRIPS. This might be in here somewhere else. TRIPS is intellectual property. There's been a great movement to protect foreign patents, copyrights, trademarks. So this stands for, of course, these letters, it says TRIPS, but I think these all these acronyms are really in French, I think, and so I can't directly translate that, but that's IPS is intellectual property. So now there's greater protections because it enhances innovation across national borders, to have people respect your patents for a certain period of time, to cut down on piracy, because that cuts down on innovation, but that's been another thing. So this is intellectual property. Okay. We're going to get to dispute resolution in 1 second. Okay, but ultimately, the Uruguay round did result in the Marrakesh Agreement in 1994, which established the World Trade Organization, WTO. But subsequent to the Uruguay round, it's gone on, and there's this thing that's been ongoing, and it resulted in those protests in Seattle a decade or so ago. Let's see, the Doha round. They've stalled. And a lot of the conflict on these rounds of negotiation has to do with poor countries known as the developing nations have a hard time complying with some of the Uruguay round agreements. And so getting them totally up to speed on all this stuff has been an issue. Agriculture is still a big issue. A big issue in, I guess, worldwide economic theory is agricultural subsidies that the United States and Europe pays to its farmers because it stifles agricultural production in developing countries in Africa and elsewhere, which is having a dampening effect on their economic development. And meanwhile, the argument is that all those farmer subsidies and agricultural subsidies are actually benefiting big corporate food producers as opposed to small family farmers. Anyway, those are the arguments. But anyway, the Doha round of the discussions under GATT have stalled. They've been lingering, and progress has been very sporadic on that front. some of these, if you see some of these quotes I have in here, they're in smaller print if you're able to read them. I don't know, but actually I lifted that from the World Trade Organization website, most of it. So in any event, just in case you wonder where those things come from, they're probably from the World Trade Organization website. This is a brief history of the level of exports in this country. And you can see exports were only at $30 billion in 1960, and today they're at $2.2 trillion. That's exports. You know, they talk about the protectionists, proponents of protectionism in this country talk about the threat of foreign goods and all this kind of stuff. This chart, I want to point out, shows that trade has actually helped on the export side employment in this country. And I think some of those charts that I showed earlier in my lecture demonstrate that. Look at that, from 30 billion up to 2.2 trillion in, 66 years. But the only problem is that imports, they've gone from 10 billion, basically 1/3 of what exports were, to 2.7 trillion. So it's not so much that exports are being hurt, it's that imports have just gone through the roof. I mean, they've gone up faster. So anyway, that's sort of an interesting little factoid in the equation in terms of analyzing whether or not the World Trade Organization is a good idea or whether free trade is a good idea. The World Trade Organization was, like I said, established at the Marrakesh Agreement in 1994. The World Trade Organization started its operation in 1995. It has 164 members. And here's a biggie right here. The members of the World Trade Organization account for 98% of the world trade. 98%. I mean, how can you afford not to be a member of a club that controls 98% of the world economy? Located in Geneva, Switzerland. All right. Basically, this organization basically is sort of the implements GATT, and GATS, which is the General Agreement on Tariffs in Services, and TRIPS, which is the Agreement in Trade-Related Aspects of Intellectual Property Rights. Okay, so 98%. Let's talk about the functions of the World Trade Organization. Oversees implementation of various treaties, provides a forum to resolve trade disputes, hears and renders decisions on complaints regarding treaty infractions, and assists in helping developing countries develop the ability to engage in trade, and it conducts research. It coordinates with the IMF, that's the International Monetary Fund, and the World Bank. Probably going to do separate videos on those two entities. They're both very important. Let's see here. Okay, let's talk briefly. This is what the WTO under GATT says its defining principles are. The biggest one is non-discrimination. Benefits offered to one member must be offered all. And this is where you come up with the concept of most favored nation status. Actually, that's sort of almost a misnomer anymore. It's like if you're most favored nation, it really means that you're entitled to equal treatment with all the other people that control 98% of the world's economy. So, it wasn't such a foregone conclusion, because China's and Russia's entry into the World Trade Organization has been more recent, and of course that adds a lot to the membership in terms of control over the economy. But anyway, all right. So no discrimination. Let's see, free. Barriers, they want to break down barriers in trade. Let's go. Here we go. The principles. I lifted this right off their website, so that's why. Let's see what this is straight from their website, the World Trade Organization website. There you can read those. You'll notice here that there is this focus on developing countries, and the whole idea, one of the major ideas behind free trade is that it supports every country, it benefits every country that engages in it, regardless of whether you're rich or poor. And I did a video on David Ricardo, and I explained how specialization and comparative advantage makes that happen. David Ricardo was kind of a sort of a disciple of Adam Smith, the father of modern capitalism. And his theory basically gave rise to a lot of this, but like I've said in other videos, a lot of the research that's been done studying whether trade is beneficial basically has said, hey, Ricardo's looking like he's right. So in any event, let me see. But anyway, one of the things about helping out developing nations is that it removes a hotbed for extremism. It reduces potentially the amount of foreign aid. It opens up new potential markets for American products, and it helps the economy of the whole world thrive, which should make everything more peaceful. And that's a major point. So it's not just a question. The idea isn't a zero-sum game when it comes to all this stuff. That nations helping each other out is a good thing. And basically engaging in healthy and free trade is sort of the basic idea behind the World Trade Organization, and sort of it's an outcome, a consequence of David Ricardo and Adam Smith's theories. Okay, World Trade. What they also want to do is they want World Trade. They want its members to publish their trade regulation and maintain institution line for the review of administrative decisions affecting trade. In specific circumstances, governments are able to restrict trade if, there are safety issues involved, to protect the environment and also protect public health. So this predictability, they also seek to instill some predictability into the process, because it allows companies to plan when they decide to make a product and invest millions of dollars into plant and equipment. Predictability of what future actions are going to be is very helpful to them. And of course, to discourage unfair practice such as export subsidies, which it looks like that's right at agricultural subsidies that the U.S. and European governments give their farmers. I mean, I know that that's a big thing. So I'm not here to pick on the farmers or whatever, but I'm just saying that this is an issue, and it has consequences. Not only does it have consequences for U.S. taxpayer, but it has consequences beyond our borders. Okay, now there's a regular, because of the establishment of the World Trade Organization, there's a regular agenda at the WTO to discuss trade issues. Now, it's very important that members have agreed on these rules. If you're a member, you've agreed on these rules to settle trade disputes. There is a ministerial conference that's a major body, but the WTO functions, that meets twice. It meets every other year, the ministerial conference. That's the main decision-making body. But really, the World Trade Organization functions all year long, and it comes down to this thing, dispute resolution. It's the central pillar of the WTO's multilateral trading system, is dispute resolution. And, okay, let's go down here. Boom, boom, boom. All right. Now, that's my... DSU is their acronym, but this is what I converted it to mean, but that's not what it... Again, I think that this DSU thing is in French, I think, but it refers to this thing called the Understanding on Rules and Procedures Governing the Settlement of Disputes. They've used the acronym DSU, but that's how I remember dispute and settlement understanding. Not sure that they do. Members have agreed. So you always got to remember, this is voluntary. Everybody's agreed. They've signed this agreement, and everybody agrees that they will use the multilateral system, namely the World Trade Organization procedures for settling all disputes, and not to take unilateral retaliatory action if another country does something that they don't, that the United States or anybody else doesn't like. You've got everybody's agreed to use this system, and to use only the World Trade Organization process. You got to understand, the first thing is they don't ultimately go to judgment on this. They put the parties in a room together, basically, and they want them to negotiate. That's major. Most disputes, probably close to 50, if not greater than 50, are resolved at the negotiation process. Panels are appointed by the DSB, and I'll tell you what, the dispute settlement body, to hear members' complaints about another member's trade practice. Naturally, the World Trade Organization encouraged mutually agreed upon solutions. Each member agrees as a condition of its membership to abide by any, they agree to abide by any judgment of the DSB, of the WTO. So there's an agreement. You signed the treaty, you agreed to a judge to abide by its decision-making process. Okay, and here's a little more. This, I've lifted this basically from their website, okay? The panel normally consists of 3 members appointed ad hoc by the Secretariat. Now this is an interesting part. Apparently, private companies and private individuals who are adversely affected by a trade policy of another country cannot take an action before the World Trade Organization. What this looks like to me is that they have to go to their own government. I would have to go to the U.S. Commerce Department, I guess, or somebody in the U.S. government and say, look, the country of, I don't know, pick one, South Africa is doing something, and it's adversely affecting my rights under GATT. Well, then the U.S. government turns around and files a complaint basically on my behalf, and everybody similarly situated to me, before the World Trade Organization. There is a right to an appeal, an adverse ruling against a country. If there is an adverse ruling you have against the United States in our case, it has a reasonable time to comply, but it's not supposed to exceed 15 months to comply. And then if there's no compliance, then there's some, you can even negotiate or arbitrate the period of time to comply. But if all of a sudden it just appears that compliance is not going to occur, the parties can to agree upon compensation. I guess that's a monetary award, and if they don't agree to that, the World Trade Organization will give the prevailing party the right to basically, well, for lack of a better description, retaliate by I guess, taking away what they call trade concessions, which is basically a concession is putting a ceiling on what your tariffs are going to be. You can remove those ceilings, and you can do something to remove the self-imposed limitations that you've placed on yourself because you're a member of the World Trade Organization. And so basically you can impose your own, for lack of a better expression, trade sanctions on the offending party. Developing countries have a few special provisions. If a dispute involves one of them, one member of the panel must be from a developing country. Incidentally, the people that hear these trade disputes have to be either lawyers or they have to be experts in international trade, but they cannot have an affiliation with any government of any country. I've lifted this from the website. Let's see here. Over 400 disputes have been brought since then. This is right off their website, World Trade Organization, without me. The fact. We've already covered this stuff. All right. I don't know if I've put this in here yet or not, but all right, more than 9% of the World Trade Organization, all right, less than half of the estate. Okay, what the point they're making here is that most of the time they don't even have to set up panels. That once the complaint is made, negotiations, just getting to that level, resolve more than half of the conflicts. More than 90% of rulings have been complied with by the responding country, and less than 4% resulted in sanctions. I guess that means permitted retaliation. So. And they're very high on this. The average time it takes to resolve has been 10 months. Now, I will tell you, I'm an attorney, and if somebody files a personal injury case around here or whatnot, you would be lucky to have the case actually tried within a year and a half. You're probably normally talking about 2 years, 2.5 years. So that's fast, 10 months. So that's a good thing. All right, so let me just summarize by saying this. The countries have voluntarily agreed. The World Trade Organization has no army or police force. Any country joining has got to accept the fact that every now and then you're going to lose. A major question is, what is a nation willing to give up to have a neutral arbitrator settle the dispute? It's the old might versus right argument. Some people want to rely on a lot of military spending and the risk of war in order to maintain sovereignty, and even then, even if you do maintain, especially in an era where you've got cyber criminals out there and chemical weapons and things like that. Having a big military doesn't necessarily mean that you're going to get your way every time anyway. So can any nation be an economic island and maintain its standard of living in the long run without looking to the outside world and engaging in trade? Well, you would wonder about whether new ideas would come in to your country which stimulates developments of new technology and things like that versus stagnation? Would you get ahead in life by staying in your home all day long and never venturing out? Would you raise your child to just stay at home and never venture out into the world? Like I said, the idea is to avoid trade wars and worse. Dispute resolution encourages discussions and negotiation between parties first. And think about the effect on domestic politics. It allows advocates in various positions to point to a neutral arbitrators justifying and providing convincing counterargument if there's in domestic policy discussions. Participation in the World Trade Organization helps to develop an international set of customarily acceptable practices and way of conducting business that's predictable in the future. Those norms and customs sort of establish a common law of international trade. And most of the law in this country is common law. It's not set forth in any statute or anything like that. And the same thing would happen, is more likely to happen if you had a neutral body such as the World Trade Organization. Ultimately, which side are you on? Might versus right, keeping your doors open to trade or not. Okay, I was going to discuss this thing called, all right, if you're for workers that are dislocated because of imports or because jobs have shifted overseas or whatever, they ought to check into this thing called Trade Adjustment Assistance. It's a federal program administered by the Department of Labor. I'm not sure, I actually had this on this script, but I had a technical glitch and it got eliminated, and that was a long time ago, and now I don't know where it is. Basically, check this, for those folks, they can check this out. There's some people say it's worked pretty well and other people say it hasn't, but anyway, there is a program for people to get money if they've been dislocated because of foreign competition for one reason or another. It's if you've lost your job because your job has been moved to another country or whatnot, or anything related to international trade, you ought to check out Trade Adjustment Assistance. It's sort of like an enhanced unemployment insurance, and there are 3 types of it. And I will just leave this. Trade adjustments, trade readjustment allowance. But in any event, I will leave that to another program. Okay, so some of the people that we have to acknowledge as providing some information. Okay, I think that's going to about wrap up the World Trade Organization video. Thanks, and we will hope you enjoyed this and found it to be informative. If you're watching this, it would really make me happy. You'd be doing me a big favor if you liked the video
And so we will see you next time. This is David Lentz for reasonandbalance.com.
Boop boop bop boop ba dum bum. Boop boop bop boop ba dum ba da dum da dum do da dum ba dum bum. Beep bop boop bop boop bop boop da ba dum bum. Beep bop boop bop beep beep boop bop ba dum bum.